So today, over the next 30 minutes or so, we're going to spend a little bit of time, and we're going to spend some time going over 4 distinct areas. We're going to look at 2018 first, in a very short, brief scenario, and look at what happened, some of the explanations around that. We'll then look at some of the seasonality in 2018, and we're going to talk about that through our 4 seasons investing, and talk about how that relates to the economic cycle and business cycle that we find ourselves in. From there, we're going to look at 2 distinct storms that hit the U.S. mainland. And then finally, we're going to look at something a little more long-term, which we've dubbed an inconvenient truth. And we'll look at some long-term ramifications of that. So getting into 2018, what happened? It was certainly a very choppy year. This is the S&P 500, the U.S. stock market. And last year, you can see, it ended the year, or in the full year, was down about 4.4%. But that masked a lot of volatility, starting with the beginning of the year. And we saw that for the first time in 2 years, the U.S. market corrected by about 10%. So it's the first correction we've seen in a while. Fast forward a little bit to spring, and we start to see the market rise. So a little bit of seasonality, and that took us really to fall, almost exactly on the date. September 20th, last day of summer, market started to correct, and we started to see a little bit of choppiness. That choppiness really was amplified Christmas Eve in the Christmas Eve massacre of a fall about 19.8%. So not technically a bear market. A bear market is anything above or 20% and above, but we were very certainly close to it. And you can see in this the seasonality that exists. So let's look at the TSX. How did it do? How did it compare to the US market? So a little rougher ride throughout the year, about 9% down. And again, a bit choppiness in the beginning, following a similar pattern in March, starting to rise throughout the summer, and in fact, fall and winter seeing a little bit further downside. Interesting thing to note is we peaked a little bit earlier here. We peaked in July, so in Canada it was a shorter summer. It wasn't as warm as, if you will, down in the States. But again, we ended up the year nearly down 9% with a 16% drop from peak to trough. We've since had a rebound. So let's look at this with respect to global equity markets. So we've constructed our own barometer, if you will, keeping our seasonal theme going here. And let's look at what happened around the world. So over here, we've got various indices. We're going to put a line down at 20%. Anything to the left of 20% or more, is a bear market, technically speaking. Our North American markets, which you can see here, many of them did not experience a bear market, with the exception of the Russell 2000, which is a small cap index, and the tech-heavy NASDAQ. But you can also see that Mexico also did see a correction. If we look at South America, certainly firmly in bear territory. And as we turn our attention to Europe, you can see Germany and Italy also experience similar scenarios. So there's volatility everywhere. And then turning finally to the Far East, you can see that for the most part, all of Asia was in bear territory. An exception would be India, which was just shy of that. So did we see that rebound? What did that look like? Let's draw a line down on the right-hand side there. Anything above 20% is a bull market. And so we saw that many of the markets certainly had that recovery, had that run up since then. We can see that certainly in South America. Europe, a little short of expectations at this point, and Asia firmly strong in the lead there. So we did see the emerging markets do particularly well in that scenario. So when you are looking at weather patterns or history, it is helpful to go back in time and say, what's this like in the context of history? Let's look at the fixed income markets first, the Canadian and US fixed income markets, starting with the American fixed income market, the yield curve. So what you have here is where the position was on January 1st and where it ended up at the end of the year. And what you can see is that on the short end, 60 basis points. So the rates rose 60 basis points on the short end and was accompanied by a rate rise of a reasonable magnitude on the long end. So a bit of a flattening of the yield curve. But what's really concerning was a little bit of this kink, where short-term rates on the yield curve in the US started to invert. And we'll talk about this a little bit later. So that was concerning. In the Canadian market, in the Canadian context, again, the January versus December end, we did see short-term rates rise a little bit. But what was concerning here in Canada, we saw long-term rates fall. So the American market was doing well, the economy was doing well. The Canadian economy wasn't doing as well, and that's why you saw a little bit of a divergence. But again, in Canada, we were a little bit concerned about this kink as well. Not as dramatic, but certainly something to be mindful of. So let's expand this beyond the Canadian fixed market and the US equity markets, and let's look at assets beyond just that. So in the bond markets worldwide, we saw some sell-offs, of course, because we had credit spreads tightening, we had interest rates rising. There's a lot of concern around that, and that also impacted real estate investment trusts, both Canadian, US, and global. I will point out that the average return on our funds was about positive 11%, so we significantly outperformed on this end. You couldn't run to commodities. Commodities were also very problematic. You could see here, especially some of the oil commodities were off significant, copper, lumber, and even some of the more exotic names. You guys all remember the big Bitcoin bulge, the marijuana was going to be the next thing. Well, last year saw some significant sell-off in those exotic marketplaces as well. So what did the recovery look like? Was it just limited to Canadian and US stocks and bonds? Clearly not. We did see some recovery, a little more muted in some categories than other.